January 9th, 2023. We had a day like this, a few months ago. I tried to look for it, but I couldn't find it, where essentially we got a big gap where we had a strong bull trend day and then a big gap down to about the 50% correction of the bull trend. And then we oscillated around it and we got a channel up to above the day's high. Now, actually, I'm going to look at one more place. You know, 20 gap bars. No, none of those. Trends, maybe. Uh, Oh, here it is. Perfect. Okay, so we got a gap. This was a strong bull trend day, and we got a gap down to around the 50%, and then we got a channel up. And when you get a gap bar, the thing you have to be thinking about is, we had 80 bars above the moving average, and then we got a bar below the moving average. And it's the first attempt for the bulls to buy at the average price. They've been paying above average for so long. I mean, a historically long time here. So they're probably going to take the first chance they can to pay the average price, which is, or below average price even here. And it's also around a 50% correction where traders want to buy. You can see on bar one, we essentially tested the 50% correction and traders bought it. So you have to be thinking that we're probably going to get back to the new high. And when you're taking a gap bar trade, the target is the new high. The gap bar is essentially usually the end of the trend, but the target is the new high. And so that's why in the slide that I showed and right here, when we got to that new high, there were tons of sellers. So that's why that happened. Because everyone who was buying down here knew the target was the high. And once we got there, all the traders just sold immediately. It was also consecutive buy climaxes, 3 buy climaxes, and 43 is the strongest looking bar in the bull trend, meaning that it's probably also a big or a very climactic bar. So with that being said, bar one, a bull bar closing near its high, maybe a reasonable buy, but I would want one to be a bit bigger if I was going to buy. You're betting that this gap down is a bear trap and that we're going to rally straight up. But I think it makes more sense to wait for 2 or 3 good bars. If you do take the buy above one, you're going to be disappointed in the close of bar two, and you're going to get out around break even during bar three. You can see that's what happened here. The traders who didn't get out, they saw 3. A lot of them probably scaling in lower, and we get some follow through for the bears on bar 4. But what's happening here, right? This is a bit of a parabolic. This is parabolic. We're breaking through the bottom of the bear channel line, and there's 3 tails. So tail 2, tail 3, tail 4, which means what? Down and up on 2, down and up on 3, and then way down on 4, meaning that this is essentially a parabolic wedge on a lower time frame. So if it's a parabolic wedge on a lower time frame, you probably don't want to be selling anywhere down here with all these tails. So after bar 4, likely we're going to bounce for a couple legs, sideways to up. Bar 5, bears taking profits, bulls scaling in lower. And 6, a big bull bar closing near its high, but again, you got to be thinking about the lower time frames. What's the problem with 5? 1, pullback, 2. So it's 5 and 6 could be 2 legs up, and 6 could be a second leg trap. It's probably a reasonable swing buy with a stop below 4, but you have to be somewhat worried about what's going to happen when you get, the follow through bar. Because when you see 6, you're probably 1 bar away from being clearly always in long, and odds are in a trading range you're not going to get that bar. 7, a bear bar closing near its low. It's a double top with 2, a higher high double top, but this far below the moving average, I don't really want to sell, especially after this pair of bull bars. I would want to see 8 be a strong bear bar closing near its low in order to sell. But it's not. It's disappointing. It's an big outside up bar. 8's a really big bar, so it's hard to want to buy 8. You could argue it's 1, pullback, 2, pullback, 3, and a wedge. And I think it's okay to buy 8, but it's a really big bar, so the risk is big. And when you get 9, you have to think, is 9 exactly what you wanted to see if you bought above 8? Not really. Is it a bad bar? No. But is it, you wanted to see a bar like 19 if you bought above 8. You wanted to see a big bull bar closing near its high. And it closes basically on its high, but it's a really small bar, so it's not all that great. So then when you get 10, why is there a tail on the top? Well, there's a tail on the top because traders, they ended up scalping out with about 5 points. Here's where it would have to get to for traders to make a 5-point scalp buying above 8. And when you buy above 8, your risk is big, but it never trades. Your true risk is tiny, meaning that your actual risk, you only had to risk to about here in order to not get stopped out, meaning that your actual risk is very small. So a lot of traders, they just took their 5 points because they were kind of disappointed at how 9 closed and were suspicious this might still be a trading range since this bar was huge. And so they just took their profits at the moving average. 11, an inside bear bar, probably okay for bulls to get out below 11. I think it's reasonable to hold, but you're right at the moving average. I think that, the target is still kind of the prior day's high. Like I said, when you get a strong bull trend and then a gap down to 50%, you should pretty much only be looking to buy until bears get, really clear bear price action that tells you the market is always in short. 12, bear bar, but just bulls exiting. 13, a bull bar closing near its high. It's a high one, but you're buying right at the moving average. 8, 9, and 10 should get a second leg, but I'm not sure that we're not going to get a deeper pullback first. And 14, kind of disappointing follow through. If you're bought above 13, you wanted a big bull bar closing near the moving average, and 14 just overlaps 13 a whole bunch and really isn't all that great. 15, more disappointment. The traders who bought disappointed 14, disappointed 15, exiting, causing 16. Follow through for the bears on 17 and 18. So you can see it's 1, pullback 2. So it's 2 legs down. And, we're around where a 50% correction probably is. I haven't looked yet, so I'm kind of just making this up on the fly. But, yeah, we're around roughly where a 50% correction is. And so traders are going to buy. You usually get a reversal around bar 18, and you can see that's what we're trying to do. Bears want to get the downside breakout, but 17 and 18, not all that convincing. They probably need one more big bear bar. And odds are, when you need one more bar, you're not going to get it. And that's why you get 19 closing essentially on its high. Now, 19 has the same problem that 8 does. It's a big bar, big risk, but it's the first bar closing above the moving average, and we know this is probably strong enough for another leg up. And we know that the target is up here. It's really far away, but it's still possible to get there. And the day is overall, because of this gap down, it's overall a bit more bullish. So where do bulls buy? Well, instead of buying above the bar, they'll buy a 50% pullback, and that's exactly where 20 went to. So traders bought the 50% pullback of bar 19 instead of buying above 19. Generally, when you see a bar and it's the bar you want, but it's a little bit too big, it's okay to look to buy a 50% pullback of that bar. Especially in a context like this where it's overall bullish and you get a big bull bar. Sometimes if you're just looking to buy the 50% pullback, you'll get trapped out and you're not going to be able to get in. It's going to be harder to get in. So I think it's reasonable to buy half your position above 19 just directly and then look to add on at the 50% pullback. But a lot of times it'll go to the 50% pullback first and then reverse up. 21, an inside bull bar. It's essentially a breakout pullback, and bulls they bought more during 20 and they're buying again. 21, inside bar, small risk, reasonable buy above for a swing, and a couple closes above the moving average, good for the bulls. And what they really want is a bar fully closing above the moving average and then get it on 22 and more follow through on 23. So we have this huge, these huge bars. And I want to talk a little bit about, scalping out of trades. When you think about, the concept of scalping out of trades, you want to be thinking about disappointment and what is probably a trading range. And when you get a huge bar like this and then kind of a disappointing bar here and more disappointment here, it's more likely that traders are going to exit. And you can see, even look at the tail on 11. Tail on 11 went almost exactly to the spot that bulls needed it to go to make those 5 points. So some traders, they saw 9, they're like, maybe, maybe not. They saw 10 and they saw a tail on top of 10 and they decided, yep, I'm just going to take my 5 points. We're at the moving average. We're probably going to get a pullback here. And they took their 5 points. Over here, you buy above 21. You see 22, there's a tail on the top, but it closes above the breakout point. It's pretty good. And then you get a great bull bar on 23. It might still be a trading range. So traders took some partial profits at 5 points, but not as much because this is not as disappointing as something like this. And then, what about over here? You can see traders able to make 5 points held through. So you hold through 49, you get 50, you're disappointed. And they tried to get out with 5 points, but they were 1 tick short. And because this was disappointing, and then it's an II after a sell climax, and after an II after a sell climax, you have to get out above the II. And that's what's driving this up, but ultimately expecting a lower high here. And then look at 57. Where's the 5 point scalp? Right here. So you can see the traders came up 1 tick short. If you sold below 57, 58's a bit disappointing, 59's disappointing, and they tried to get out with 5 points on 60, unable to, market bounces, and then basically right when it gets there on 63, they all scalp out with 5 points. So you can see when you get stuff that's less disappointing, when you take your entry, if you're disappointed with your follow through, it's best to look to get out with a scalp because the market's probably in a trading range. Versus if you're excited about your follow through and you're happy if you're trying to follow through. I mean, if you buy above 21, you're pretty thrilled with 22 and 23 for the most part. So it makes more sense to look to buy there. And you get 22. So anyways, I said 21, reasonable breakup, pullback buy, follow through 22, 23, and a pullback on 24 since it was around 5 points. Another leg up on 25, but this is three. It's essentially a wedge. So 1, 2, 3, and we end up getting consecutive buy climaxes 1, 2, 3, and a larger wedge. But this is a smaller wedge. You could argue it's a parabolic wedge, but it's not a good sell. You get 26. Some bulls might start to get out and look for a couple legs sideways to down, but you get a kind of surprising high 1 on 27. And now you got to be thinking about what he talked about yesterday, right? 2 open gaps. open gap here. This is a body gap, right? The bodies didn't overlap. I think you could argue that, it's more like this breakout point. Either way is fine. But the important part is there's an open body gap right here, meaning the bodies did not overlap. And then what about the traders who sold this breakout point? They sold above, tried to scale in higher. They're trapped. So you now have two sets of trapped traders the same way that you did yesterday. And when you have two sets of trapped traders, a lot of times those traders are never able to get out, and it'll lead to a trend that could last all day. I did not think this trend was going to last all day because it was so strong yesterday, and it was unlikely that we were going to get that 2 days in a row. But I thought there was a pretty reasonable chance we got up to there. And, this is a high 1 on 27, so it's usually a lower probability buy, but you're generally in the spike phase of the bull trend, so okay to buy, and you have two open gaps, so okay to take the buy above 27. Doji bar follow through on 28, and then a big bull bar 29. You can, instead of buying above 27, wait for higher probability and buy the breakout above 25 high or buy above 29. Big bull bar on 30, and some profit taking 31. Why is there profit taking after these huge bull bars? Because the risk is big, right? So if you're buying above 27, if your stop has to be below 27, theoretically, if you're buying above 30, and your 1-to-1 is not all that good. And if you could instead buy a pullback, so let's say you bought the low tick of 31, now your risk reward is here. And so you got in down here looking to get up here, and you have better than 1-to-1 risk reward. So it makes the equation better, and that's why traders bought. I wonder if you bought the close. I'm just going to check. Okay, not quite as good. But anyways, so 31, a pullback, 32, a bull bar. But we're pretty high up in the range. At this point, we're close enough to this high that we're probably getting there, but I think it makes more sense to get out. I think 33, a lot of traders will just exit below 33. You get the bear bar 34. Can you buy again above 35? You probably can. Thinking that we're so close to this magnet, we're probably going to have to get there, and you have reasonable 2-to-1 risk reward. So I don't think it's the worst thing in the world to buy above 35. But it's just you're really, really high up in this range. So you got to be quick to get out. And it's kind of hard to sit through all of this and, get that. Your premise is definitely still valid that we're going to this high, but I just think it's difficult to do. Bad follow through 36, double top 37 with 33, but disappointment 38, bull bar 39, but not all that great, and disappointment 40. We're just in a tight trading range at this point, and we get a breakout above the tight trading range on 43. Probably go up for a measured move of the tight trading range, maybe even a little more, I guess. Probably more than just the bodies, though. I'm just kind of like messing around here. I'm not sure what exactly is what. But, you can see that the measured move of the tight trading range is around the high of the day. So there's going to be a lot of magnets up there. I wonder if just these bodies, this spike up, no, too high. Okay. But anyways, 43 gets you to the target, which is the high of the day. And it's the best looking bull bar of pretty much the entire trend, right? You could argue it's basically the exact same bar as 19, except 19 came very early in the trend, and now we're like 40 bars into the trend. So when you get that kind of bar, it's probably climactic, and we're at a very important resistance area. Not surprised you get a big bull bar or big bear bar here. Everyone's exiting. And now you got to be thinking we're going sideways for the most part for the rest of the day. This tight trading range will probably limit the downside and the upside for the rest of the day, but we might get a deep pullback. 45, bull bar, but not all that good. A high 1 for the bulls, betting that 44 is a bear trap, but it probably going to get a lower high even if we trigger it. 46, bear bar closing near its low. It's an inside pattern. Some traders could sell below 46, hoping that we get a collapse. 47 is pretty much ideal follow through if you sold below 46. I don't know if they were able to make 10 points. Oh, look at that. So the traders who sold below 46, they were looking for a swing, not a scalp. You have to be swinging if you're taking this kind of sell. And they got 10 points, reasonable swing trade profit, and that's where they took profits. 40 traders who sold below 47 waited for higher probability, so they made a bit less money, but they were still able to make a little more than 5 points. Yet follow through 48, 49. I wonder if. So that's kind of funny. If you sold below 46, and let's say you held as an always in position, then you would have to get out basically above the II. And if you're getting out above the II, you were able to make 5 points instead of 10, which is exactly a scalp. So the traders who sold below 46, some of them took profits at 10 points, some waited for the II and exited above and took their 5 points. And that's what causes such a big bounce on 52 is the bears buying back shorts. Follow through on 53, but realistically, after this strong of a bear trend, I think we're probably going to get a lower or bear move, I suppose a correction, 2 legs down. We're probably going to get a lower high. So I'm not surprised that this forms a lower high. 54, disappointment. Traders, they see 53, not quite what they wanted, and a lot of traders who bought above the II hoping to trap the bears, which they did, are, have pretty much accomplished their goal, gotten their 10 points. And they wanted to get back to the top of the most recent sell climax, which is here or here. So I don't think that I think it's a lot of traders taking profits there. 55 touches the close of 53 and sells off. 56, essentially a second leg up for the bulls. And then a big bear bar closing near its low 57. Can you sell below 57? Probably. It's a lower high. And it's probably, pretty clearly always in short. But the thing is, if you're selling below 57, you kind of have to manage your expectations. I mean, what are the odds that we're going to get a giant bear trend here? Really not all that great. This bull move still has some effect on the market, but this is strong enough that I think we're probably just going to go sideways at this point. So if you're selling below 57, you have to expect some buyers at the 51 high where bears got trapped, bulls got trapped, scaled in higher, and are exiting around break even. So disappointment on 58, not all that surprising. Trades above the high of 58 on 59, but a doji bar and follow through on 60. So it could be one pullback two. So traders are trying to get out with 5 points, hoping that this is not a second leg trap. And you can see they're not quite able to. The 49 closes a magnet because traders sold that close and sold more higher. And you can see during 70, it got hit. 61 bill bar closing kind of near its high. Traders might get out above it since it's around break even and they could just wash the trade at that point, but doesn't end up triggering. 62, low one short, or you could argue low two short, closing near its low, but you're selling very low in a trading range, and then traders just scalp out with 5 points. 64, you could say one pullback, two pullback, three wedge down to 64. Probably better to exit above 64. Spike, and then channel, you could argue on 65, 66, but we're just in a trading range at this point. Big bear bar 67. I would honestly just be done for the day at this point. Big bear bar 67. Traders bought, 68. Traders bought. They bought more lower at the low. They bought more at this close. They scale in. They bought below 67. They're getting out around break even on that first entry with a profit on that second entry, at least 5 points. 70, inside pattern, but chances are this is a scalp at best, and you got to be really fast to handle it. Those traders were probably hoping to get back to maybe the 56 low since traders got trapped there, but it ended up only getting to the 54 low since that's the bottom of the tight trading range. So it tested back to the bottom of it. And then we tried to get a downside breakout, but you can see you're just selling the bottom of a trading range if you're selling something like 75 and it's so late in the day. And it's really easy to just get trapped like this at the end of the day on some bars like 77. So I think that once we start to go this sideways, I think the last trade is really 57. And then when you scalp out, hopefully you scalp out down here or exit above 64, you probably just walk away. Maybe you sit and watch until, 68, 69, but I would just get out after that and be done. Stop orders, I think it's okay to buy above 8. Okay to buy above 19, 21, 20. You can buy the close 22, buy above 23, buy above 27, 29, 30. You probably buy 35, probably sell, 46, 47. Probably could buy above 51, and you could probably sell below 57. But I just thought that, when if you take one thing away from this video, when you get a big gap up and when you get a big bull trend day or a big bear trend day, but this was a big bull trend day, and you get a gap down to 50% after a big bull trend day or a gap up to 50% after a big bear trend day, and you had at least 20 bars, we had 20 plus bars above the moving average before, you should be expecting the market to try and test because there's going to be traders looking to buy right here. Same way there'd be traders looking to sell a 50% correction of the bear trend. On the daily chart, bulls who bought this close, bought more lower, kind of disappointed. So once we got to this high, they sold out of the longs around break even. I'm expecting the market to go pretty sideways for the next couple of days. I think we're going to be, maybe we'll go a little lower, maybe we'll go a little higher, but I think for the most part, we're going to stay within this relative range. I don't even think we'll get all the way down here. We might, but I think most likely if we get below here, there'll be buyers pretty quickly with how strong this is. If we go up, I think the bears who sell above this high are going to make money. And if we go down, I think the bulls who buy below here are going to make money. So trading range overall. Weekly chart, bull close, trying to touch this week's close. So I think the close of this week will be important, which is 48.13.5. So I think if we get back to that close, that'll be a really important. So I would say that's an important resistance area. And yeah,